Well, gold remains at relatively elevated levels compared to historics, although it's off those peaks of $1,900 an ounce right now. What have you made of this meteoric price rise that we've seen so far?
Thank you for having me, Alishia. Well, it's no secret. The global economy has fallen on tough times, and the major economies in the world are very indebted, and the question is, how do we get out of that? Lots of quantitative easing, lots of money printing, lots of inflation. So gold has done very well.
Done well because of its safe haven appeal specifically, and how that ties in to inflation on the rise, right?
Yes.
Okay, so let's go through it and what's actually been supportive of, of this price rise, because fundamentals have really been brought into question by many traders at the desk in terms of just how sustainable a price at these levels is looking right now.
Well, talking about the sustainability of the gold price, you then need to come out with what you think is an appropriate value for gold. And valuing gold is an inherently difficult task. There are a number of reasons why the gold price moves. Inflation, we know; risk aversion, we know. And we can try and formulate a price, from using some of those factors. But ultimately, valuing gold is very difficult.
Very, very difficult, especially where you also have question marks around its status in terms of a safe haven asset. I mean, the drivers of the gold price, certainly in terms of uncertainty, has been the fact that it's a safe haven asset. And when people fear inflation, they see gold as something that would retain its value. But there was a point in time where it lost that status temporarily and adopted more of a characteristic in line with risky assets, with investors needing to sell out to fund losses elsewhere. So how do you balance that, and are we looking at a safe haven status that's intact right now?
That's another complication with gold, where there are various factors which can drive it, and they're constantly changing. I mean, we've heard stories of gold also being a separate asset class where it sometimes behaves like a currency. So we would rather stay away from gold.
Okay, so let's look at it and let's lay the cards out on the table. You've already alluded to the fact that you're staying away from gold. Let's put that investment case on the table and how you're assessing it. Okay,
well, we like income-producing assets. Over time, research has shown that dividends are a bigger contributor to returns when you're buying equities, and gold doesn't have a yield. It's an asset which doesn't have a yield. So we like income-producing assets, and also, we are value investors, and we invest where we see value. So we do some work, we do some research, and we try to figure out what an asset should be selling at. And when the market presents an opportunity for us to invest, we go in. But like we're saying now, with gold, we can't really determine where it should be selling at.
So let's take a look at some of the other ways and avenues that you could be exploring to gain exposure to this gold price, because certainly a gold price sitting at $1,600 an ounce is a hard one to ignore. And interesting in your note, I mean, you've said physical gold is surprisingly more risky as an investment than shares in gold mines. And I've got to say, really? I mean, this goes against what many of our traders have said at the desk, especially if you're looking at a South African gold miner.
Well, that riskiness that I referred to in my note there is about price volatility. But also, I mean, for the gold mining companies, the gold price is one of many factors which they have to manage. And, the more factors there are to manage, the more things that can go wrong. Right now, South African mining companies are facing a lot of cost pressures, so that's something else they have to deal with. So I think that's why investing in gold companies as well is tricky.
So tricky to invest in gold miners, tricky to invest in the gold price itself. How do you get exposure to this gold price?
Well, that's if
you want it.
That's the main question. Do you want exposure to it?
Okay, so safe to assume that you don't want any exposure at this stage?
Okay, well, I don't want to sound like I'm being bearish on gold, because stories have been bandied about possibly reverting back to the gold standard. And if that happened, we would be looking at a gold price of around 5,000 US dollars. So, I mean, and in that environment, you can pick a gold miner. They'll all make money. But I would just like to be invested in something that I know, that I understand, and that I'm comfortable with.
So where are you casting your glance right now?
Where am I casting my glance? Okay, well, in general, commodities in general, I think they have a lot of the advantages which investing in gold has, and other advantages over and above that. Platinum as an example. It's also a precious metal, and it exhibits the same characteristics as gold, but also it has a strong fundamental underpin because it has a lot of industrial demand. So in the case where the global economy crashes, it will go up in line with gold and as an inflation hedge. And in a situation where the global economy doesn't crash and actually does well and recovers, then the demand will rise.
How do you assess valuations on ETFs particularly? Because whether you're looking at gold or platinum in this instance, we've seen the rise of ETFs as a separate asset class and how it's gaining traction amongst the investment community.
Well, valuing ETFs comes down to valuing the metal itself. So same complications with investing in gold.
Well, let's leave it there. Thanks so much for your time this afternoon. Of course, Takura Mahwehwe is a portfolio construction analyst at Cannon Asset Management.